There's this feeling when you check your retirement account, not the quick glance you do on your phone, the actual sit-down check. You log in, you see the number, and for just a second your stomach drops. Not because you haven't been contributing. You have. You've been responsible. You did the 401k. You increased it when you got raises. You read the articles about compound interest. You didn't touch it during the pandemic when everything felt uncertain. But the number feels wrong. You're 45. You've been working for over 20 years. The balance shows $45,000, maybe $60,000 if you've been aggressive. And somewhere in the back of your mind, there's this quiet calculation happening. This math that doesn't add up. Because you've heard you should have 1 times your salary by 30, 3 times by 40, but you're 45 and making $83,000 a year, and the actual target you need is $250,000. You're not close. And you did everything right. That gap isn't a personal failing, it's a structural outcome. And what I found when I started pulling the data isn't that people became worse savers. It's that the math of retirement changed underneath them. And most people never got the memo. If that sounds useful, stay. Hit subscribe, and if this helps, give it a like. Let me show you what actually happened. Federal Reserve Survey of Consumer Finances, 2022 data, released 2023. Still the most comprehensive look we have. Ages 45 to 54, median retirement savings, $45,000. Not average, median. Half of all Americans in their peak earning years have less than that. The average is $313,220, which sounds better until you realize the average is being pulled up by the top 10%. The typical person at 45 has $45,000 saved. The guideline says they should have 3 times their annual salary. US median household income in 2024, $83,730. 3 times, that is $251,190. Call it $250,000 to keep the math clean. The gap? $205,000. You weren't irrational to feel behind. You are behind. Not because you failed, but because the benchmark was built on assumptions that no longer hold. And here's what makes this structurally dangerous. That 3 times salary rule was designed for a different retirement math. It assumed you'd have a pension, that Social Security would replace 40% of your income, that healthcare costs would be manageable, that you'd work until 67 and live maybe 15 years after that. Every single one of those assumptions has changed. Pensions disappeared. In 1980, 38% of private sector workers had a defined benefit pension. By 2022, that number was 15%. For people under 50, it's essentially zero unless you're a government employee. Social Security replacement ratios are dropping. In 2000, the average benefit replaced about 39% of pre-retirement income. By 2024, that's down to 37%. And the trust fund projections show benefits getting cut by 23% in 2034 if Congress doesn't act. Healthcare costs exploded. Fidelity estimates a 65-year-old couple retiring in 2024 will need $315,000 just for medical expenses. That's separate from the retirement savings target. That's just the cost of not dying before you're supposed to. And life expectancy at 65 increased. In 1980, if you made it to 65, you lived on average another 16.4 years. By 2020, that's 19.4 years. You're funding an extra 3 years of retirement on the same savings timeline. The 3 times salary guideline didn't change, but the world it was built for disappeared. This didn't happen overnight. It was a 30-year policy shift disguised as personal responsibility. Congress passes the Revenue Act. Section 401k gets added. It's not designed to replace pensions. It's designed as a tax-advantaged savings supplement for high earners. A way for executives to defer income. 1980s. Companies realize they can shift retirement risk off their balance sheets. Instead of funding a pension that guarantees a payout, they can offer a 401k and make the employee responsible for contribution decisions, investment choices, market risk, and longevity risk. The transition was sold as freedom. Take control of your retirement. Build wealth through the market. What they didn't mention, you're now competing against professional money managers with a 401k menu of 15 funds and a retirement calculator that assumes 7% annual returns in perpetuity. By 2000, the shift was complete. Pensions were legacy structures. The 401k was the standard, and the entire model assumed that people would start saving at 25, contribute 15% of income every year. Never touch the account during job changes, never take loans against it, invest aggressively in equities, never panic sell during market crashes, work continuously until 67. If you did all of that perfectly, you'd hit the target. Most people couldn't do all of that, not because they were irresponsible, because life happened. Student loans delayed saving until 30. So job changes meant 401k rollovers that sometimes got lost or cashed out with penalties. The 2008 crash wiped out accounts right when people were hitting their 40s. The pandemic caused contribution pauses, layoffs, emergencies that required withdrawals. The system was designed for a theoretical perfect saver who doesn't exist. And while that was happening, the market itself was changing in ways that made the traditional retirement advice increasingly fragile. Here's what most people don't see when they look at their S&P 500 index fund, December 2025. The top 10 stocks in the S&P 500 represent 41% of the index. 41%. Nvidia alone is 7.8%. Apple 6.9%. Microsoft 5.4%. This is the highest concentration since at least 1972. In 1990, the top 10 stocks were 19% of the index. You had IBM, Exxon, General Electric, Philip Morris. Different industries, different risk profiles. If one sector collapsed, it didn't take down the entire index. By 2000, at the peak of the tech bubble, top 10 concentration hit 27%. That unwound badly. The Russell 1000 Growth Index fell 57% from 2000 to 2008. If you were 45 in 2000 and had your retirement savings in growth stocks, you lost 8 years of gains. We're now at 41% concentration. Not in a bubble, in a structural shift. The market is AI, cloud computing, and digital advertising. 7 to 10 companies dominate, and they're trading at a weighted average of 29.9 times forward earnings, while the other 490 stocks in the S&P 500 trade at 19.5 times earnings. What that means, if you're contributing to your 401k index fund, 41% of your new money is automatically flowing into 10 companies. You think you're diversified. You're not. You're concentrated in a handful of tech stocks at historically high valuations. And when these stocks underperform, not if, when, your retirement account takes a disproportionate hit. The people who set the 3 times salary benchmark in the 1980s assumed you'd be buying a broadly diversified index. That's not what you're getting today. And this matters because the standard advice is to shift from stocks to bonds as you approach retirement. But if you're 45, with $45,000 saved, and you need $250,000, you can't afford to de-risk yet. You need growth, which means you need to stay exposed to this concentration risk for another decade. I started looking at who actually hit the retirement savings targets, not the medians, the people who made it. The Federal Reserve data breaks this out. Among households with retirement accounts in the 45 to 54 age range, top 10%, average $1.3 million. Next, 40%, average $313,000. Bottom 50%, median $45,000. The top group is fine. They'll retire comfortably. They likely maxed out 401k contributions for years, got employer matches, had IRAs, maybe stock grants or bonuses. The middle group is close to the target. They contributed consistently, had stable employment, didn't panic during market crashes. The bottom half is behind, not by a little, by a structural amount that can't be closed with budgeting tips. And here's what determines which group you're in. It's not discipline. It's starting conditions. The people in the top group started saving earlier, usually in their 20s. They had employers with generous matches. They didn't have student loan debt. They avoided job loss during the 2008 crash and the 2020 pandemic. They stayed in the market during downturns. The bottom half faced different conditions. They started saving later because they were paying off student loans. They worked for companies with minimal or no matching contributions. They changed jobs and accidentally cashed out 401s in Ks. They took loans against their retirement accounts during emergencies. They pulled money out during the 2008 crash and missed the recovery. Same advice, different outcomes. Because the system rewards people who never encounter friction. If you're in the bottom 50% at 45 with $45,000 saved, catching up requires either doubling your contribution rate immediately and maintaining it for 20 years, taking on significant market risk and hoping for above-average returns, working past 67 and delaying Social Security to 70, accepting a lower standard of living in retirement. Those aren't strategies. They're adjustments to a shortfall that was created by structural changes you didn't control. Here's what I keep coming back to. The retirement savings benchmarks: 1 times salary by 30, 3 times by 40, 6 times by 50, were created in the 1990s and early 2000s when the average 401k had been around for 15 years. Pension coverage was still above 20%. Social Security replacement ratios were higher. Healthcare costs were half of what they are now. Market returns from 1982 to 2000 averaged 17% annually. Concentration in the S&P 500 was under 20%. None of those conditions exist today. But the benchmarks didn't change. The financial services industry kept using them because they're simple, easy to communicate. 3 times your salary. People understand that. What they don't communicate, that target was built for a financial system that no longer exists. Why, if you rebuilt the retirement savings guideline using today's conditions, no pension, lower Social Security, higher healthcare costs, longer retirement, more concentrated market, the target at age 45 wouldn't be 3 times salary. It would be closer to 4 or 5 times salary, which would put the realistic target at $335,000 to $420,000 for a median income household, not $250,000. Suddenly that $45,000 median looks even worse. You're not just behind the old benchmark, you're catastrophically behind the benchmark that should exist and nobody told you, not your employer, not your 401k provider, not the financial news you read. Because acknowledging the new math would mean acknowledging that the system isn't working for most people. That would require systemic change. Expanded Social Security, mandatory retirement contributions, public pensions, healthcare reform. Instead, we keep the old benchmarks and tell people to cut lattes. If you're 45 with $45,000 saved, you're not alone. You're the median. Half of Americans your age are in the same position or worse. You weren't irrational. You weren't undisciplined. You were following advice that was built for a system that no longer exists. The gap between where you are and where you need to be isn't a personal failure. It's the outcome of 30 years of policy decisions that shifted retirement risk from institutions to individuals without adjusting the benchmarks or safety nets to match. The 3 times salary rule told you that if you just saved consistently, you'd be fine. It didn't tell you that. Pensions would disappear, market concentration would triple, healthcare costs would quadruple, you'd be funding an extra 3 to 5 years of retirement. Real wage growth would stagnate for 2 decades. You'd face two once-in-a-generation market crashes before age 50. The advice didn't change. The world did. And now you're at 45, looking at a number that feels wrong, running the mental math, and realizing it doesn't add up, because it doesn't. Not because you failed, because the rules changed and nobody updated the scoreboard. You can keep contributing, you can increase your savings rate, you can work longer. Those adjustments help. But they don't close a $205,000 gap. They just make the eventual shortfall less severe. The clarity isn't motivational, it's structural. You're not behind because of what you did. You're behind because of what changed around you while you were doing everything they told you to do. I'll keep tracking this: the retirement savings data, the market concentration, the policy changes that nobody talks about, because the benchmarks we're told to follow were built for a different economy. And every year they stay unchanged. The gap gets worse. If this was useful, subscribe. I document these patterns as I find them. No courses, no products, just the data and what it actually means. Thanks for watching.